Hi, everyone. This is Tyler Morris, Wealth Advisor at BWM Financial. Thanks for joining us today for our market commentary webinar. Jeff will begin his presentation in just a moment, and we're expecting the presentation to take about 30 minutes. Everyone that has joined is on mute, but please feel free to ask questions throughout the presentation using the chat feature. We are going to be answering all questions that come in during our Q&A session at the end of the presentation. We are recording this webinar, and the replay and slides will be posted to our website soon. And finally, if you don't already, please follow us on Facebook and LinkedIn. We share replays there, recaps, articles, and videos, and occasionally some fun staff photos. So we'd love to connect with you on social media. And with that, I'll turn it over to our president, Jeff Brown. Jeff, take it away.
Hi, good afternoon, everybody. Welcome to the webinar. Based on the market in the last couple of days, I think I titled this very appropriately. That our investment committee decided to call it conflicting signals in an unpredictable environment, and that is exactly where we stand today. While I wait for a few more people to get joined, just spending a minute, Allison brought up the fact, I don't know if you see there's obviously I don't do video on these just because I'm looking at the charts, and it would be fairly hilarious watching me look at the charts while I'm talking to you. But you see a picture of me surfing in Fiji, where I just was. I want to live that dream a little bit longer. And one of the things we profess here, at least for our clients know, is that maximizing your life. And I think as we look at the markets year to date and such, sometimes people get nervous and everything about what's going on and what should we do, and that's standard. That's human behavior. And I think the key part about marrying the financial planning to the life coaching to the investment management is being able to let people know, like, are you okay? And to get through these environments that are tough. Because they are, and this is just part of investing. If you were investing and it was all going straight up, well, that's investing in cash, and it's going up at a very, very small pace. So I'm going to talk today about why we believe that there are conflicting signals, and you'll see me mention at the end is there are times to have a lot of conviction about where we think things are going, and invest accordingly. And that is not this particular time, in our opinion, because there's so many different things at the present time. So let's just start off by looking at where we are this particular year. What I'm showing here is just a variety of asset class indexes for the year to date as of, I don't know, a few days ago. So if we look at the lower part of the chart here, I highlighted everything from treasury bonds to corporate bonds, high yield bonds, municipal bonds, NASDAQ, international, emerging markets, REITs, right? There's no place to hide. It's been a very, very tough year this year. In fact, it has been the worst year for a 60-40 portfolio ever. So think about that, ever. Because bond and stock prices have moved the same way. Now, we've done things in our portfolios, brought out alternatives to the right clients and a lot of other things where we think we've tried to help ease some of the pain here. But nonetheless, it's hard to hide from something like this where diversification just really sends everything down. One place to note is I did highlight what we call diversified alternatives. And there's different types of alternative investments for certain high net worth clients that make sense in this environment. This may not stay here either. This could also decline. But very few places to hide across the portfolio. So what I want to go is I go through this. I want to talk about the different types of signals that we're looking at, both positive and negative, and try to paint both sides of the story, let you know how we're positioned, and let you know exactly what we're looking at to make the next change across things. So right now, what I'm showing you is a chart. I try to make it consistent in terms of how these charts are. So I'm not showing everybody new something because this is new every time, because I hope to people get used to looking at similar things in terms of where they are, because these are not for people don't look at these types of charts every day unless you're me or the investment committee on our team. But what I'm showing you here is the global composite PMI. What is this? This is the Purchasing Managers Index. What is that? It's taking a look across the major countries in the world, and it's saying, how are the services and the manufacturing industries performing? And anything above a 50 is in expansion territory, and anything below 50 is in a contraction. Contraction, therefore, being recessionary in some degrees. So you can see here, although we've come down from the highs of where we were in 2021, which, by the way, were the highest level that we had seen in over a decade, okay, because of the quick expansion that we've had, we're still bouncing along. We have not fallen into contraction territory. This works for both manufacturing, despite all the supply challenges that we're having, and of course in services, despite the fact that we had another resurgence in COVID at the beginning of the year. So the global economy, I'll rank it as neutral because we have declined from the highs of growth, but we are still expanding. And unfortunately, it's these times when we go into recession, it tends to happen fairly quick. So it can change from here, but looking at real-time data as of a month ago, we're still looking pretty good across the globe. Now, we care a lot more, at least our clients do, about the United States, except for their international holdings. And Ned Davis, our primary research provider, has a series of indicators that they look to be able to say, hey, are we in a US recession probability? And right now, 0 of these indicators are showing that we're in a recession territory. In fact, if we were, the Fed would probably not hiking interest rates, right? So the Fed moved 50 basis points yesterday. We'll get into that in just a moment. But so far, the United States economy appears strong. What does that mean? It means we're probably able to withstand the Fed getting back to a more normalized rate environment. Once again, I'll get back to the Fed a little bit later. But this is a positive in terms of, because you can have a correction in the markets. They happen all the time. The bad corrections occur during recessions. Now note that this can move pretty quick as well as the economy tends to slide fairly quickly, but generally we have some level of warning ahead of time. So one thing that's positive that we see, and this is a complicated chart, but we use this all the time, is what we call a breadth thrust, okay? What does that mean? A breadth thrust means the market, think of it, the market has a series of floors and ceilings, places where people, whether you look at individual stocks, indexes, or what have you, you have a time when you have a majority of the stocks that move together, resetting a new floor in. And what that means is there was a lot of buyers at that floor. And it tends to be that becomes a new bottom, and it can set the stage for another rally. And so there are several of these breadth indicators that occur. We had a couple fire on around about a little more than a month and a half ago. Okay, so I highlighted the box where it was done. It was done on March 18th, and we were hoping for follow through here. All right, we had already cut exposure to stocks across the board in our portfolio, and we were thinking that, hey, we might have not that might have not been the right call, because breadth thrust happened, not too long after that. And then, but as you can see, that hasn't materialized. But that doesn't mean that it has to materialize in the short term. Okay, this is more of it can mean in the short term, it has, but in a longer term, this has a very high degree of success at taking a look at positive 1-year returns. And as Ned Davis does, they always back their data up with looking at the past. And this is fired a total of 36 times since 1980. So since 1980, only 36 times, that's not a lot given that amount of years. 35 of them have been positive. 1 was negative, and that was in 2007 because the financial crisis came after. And the median return was up 16.67%. And by the way, this date was actually slightly higher on the market than where we are today. So this was a positive. Unfortunately, as I move into the next slide, we look at something different. This is a chart I feature on every single webinar. It's Ned Davis's flagship indicator that tracks the health of the market in a more intermediate term basis. They call it Big Mo. What is it? So if we look at the bottom, looking at the bottom part of the chart, that orange line, when that line is high, that means the market is firing on all cylinders. And that means that sectors within the market are all participating, and it means stocks within each sector are participating. When that line begins to deteriorate, it means that either sectors are breaking down, that stocks within sectors are breaking down, or that both are breaking down. And we look for this to be in a bullish zone where we feel or going that direction, rising towards that bullish zone for us to feel confident that things are moving the right way. And the way I like to mention this, the analogy I use is it's called momentum. Okay, there's momentum and then there's breadth. Going back to the days in the Wild West, right? Momentum is which way the wagon is going, and breadth is how many horses are pulling that wagon. And if you have a large number of horses pulling the wagon, it's a very strong, powerful force. Unfortunately, the bearish piece of this is that this is in the bearish zone. It's actually in the worst place it's been since COVID. So while we had some good short-term indicators, the more intermediate term has failed to participate. And that's why we did not and still have not increased our exposure to equities. On top of that, we're not at a great time of the year. Now, this is, we don't invest according to this, but markets do sometimes rhyme. And this is looking at the 4-year presidential cycle, and we're coming up on the midterms this year. And historically speaking, this is one of the 4 years. First off, this is the weakest historically of the 4 years of the presidential cycle. You tend to have a pretty good first year of that cycle coming through as monetary policy changes, as the party sort of gets some momentum going, and then for one reason or another, people begin to move away from that. Right? Things don't always go so well. Monetary policy begins receding. There's sort of the jockeying for the midterms, and we tend to have a market decline that usually happens from April till around October. Now, we obviously, you see this is the line showing where we would go today through there. This is like, it's more the direction and not the dollar figure. And then you look at the chart, it shows a 0% return down 2.5%. So not a big deal. That's occurring today, as a matter of fact. So it's more the direction. So we do have this as a potential headwind going forward. Now, one thing that we can view as both positive and negative. So gave you some positives, I've given you some negatives. So those are conflicting. Another part's a bit conflicting is the PE ratio of the market, of the US market. The PE ratio is how expensive the market is. It's the price divided by the earnings of the market. And we got to a very elevated PE ratio after the COVID rally, okay? That was for a lot of reasons. One is because earnings had to catch up. Stocks moved in advance of those earnings. So, and it made sense that we would trade at a higher multiple because interest rates were so low. Well, a couple things have changed. Interest rates have risen, stocks have declined, but most importantly, earnings have increased. So that PE ratio has now come back down. So we have removed some of the excess, but you can see we are still somewhat elevated. If stocks were to stay in the same place that they are today, like not moving, but by the end of the year, and earnings were to come in as expected through the rest of this year, this would actually move down into this next bracket without stocks having to decline, because earnings are still expected to increase roughly 10% year over year. And that still looks to be holding as we're going through earnings season today. So this isn't a no-brainer that it's so cheap we got to be piling in, but it is better and it's a more attractive entry point than we were just a year ago. One thing that is very bullish from our point of view is sentiment. And sentiment is a contrarian indicator. Sentiment's how people feel about things. And I don't know about you, but I haven't felt great about the market, right? I do this for a living. I still haven't felt great about the market for some time this year. What do we have? We have supply chain issues. We have inflation worries. We have the Fed taking the punch bowl away, and we have a war going on. Those are a series of bad issues, not to mention COVID in the background. So it's hard to get really excited about the market, and that's where sentiment gets negative or pessimistic. Well, we can see here that sentiment is very pessimistic, and it's been so for a lot of this year, which has historically been good for the markets. In fact, if we look at this box down below, which I didn't highlight, but I'll use my mouse to do so, typically when we're in this range, the market appreciates at about a 28% annualized rate of return per day. When we're in the excessive optimism zone, that high zone, we're about a negative 4% per day. So obviously, it hasn't been appreciating at 28% in this particular day, but you look at yesterday and some other days during this when we've been here, it has been. So it is more concerning when we have large market declines and we're in the excessive optimism zone, because that means we probably have a little ways to go before we shake people out. If this thing gets a lot lower, like it did a little earlier this year, it did spur a pretty good size rally. And you know what? After a day like today, depending upon how it factors out, that could occur. So this is a bullish signal for sure. Now, international equities, for clients that follow us, we did increase exposure to international relative to US in our retirement tax deferred accounts where there was no taxes to be paid. I'd say so far that's been a neutral change because of the fact that the US dollar is appreciated. So the equities are, if you look here, this is the same chart that looks at the health of the international broad-based. So it's everything outside of the United States weighted by capitalization. And this is in the neutral zone. This is actually better than the other one was showing. But we've had some currency headwinds that have occurred as our interest rate differential is greater than outside of the United States. So, but international stocks, at least as of recently, look healthier than the US stock market does. So, fixed income. Like I mentioned, this is the, well, fixed income, I think, is you have to go back to the 70s to have a worse year for fixed income in terms of percentage decline. And that's, the Fed's only hiked twice this year, and they're expected to hike, I don't know, 4 more times, maybe 5 this year. So how much worse can it go? So Ned Davis did a great job looking at this, taking a look at the beginning of a tightening cycle, okay, which is there's been a series of them starting in 63 was when they started measuring this. Then the end of the tightening cycle, when they stopped raising rates, and they say how many days that was, and the beginning value of the interest rate and the ending value. So how much it started from the time before they first started raising rates until they were done. Now, it should be known, the Fed rarely comes out and raises rates out of the blue. So the market usually preempts that, as it did this year. And I put on the left, the start date for their current hiking cycle was 2.19%. That's when they started. That was the day before they made their first interest rate increase. As of this, for distraction purposes, I don't have it up right now, but as of earlier today, it was over 3%. So that's 80 basis points. If we look at the median change, it's actually 60 basis points. We've already moved faster than the median of all those above. And if we look at the mean, it's 1.33%, which means that would be about another 0.5%. That's my math serving me correctly, hopefully. Another, call it around that level, 0.5% or so in interest rate increases. So it could be perhaps that the bond market is doing a lot of the work for the Fed at the present time. Okay, so the bond market could be doing that. I'll get into that when I talk about real estate next. Oh, it's actually on the next slide. So real estate's done fantastic for people that own homes, especially in desirable locations. After COVID there's been this new desire for different locations out of the cities into places like San Diego, where we are, or into the mountains, or Montana, what have you. So you have this, these desired locations, and so real estate's been a very attractive investment. And what do people do when they see something doing well? Well, they want to buy more of it, right? So, and that's we get those questions quite a bit. So what's the future for the real estate market? Well, I've talked before about the low level of supply of homes. I didn't bring it up here because you can just trust me that it's very low levels of supply out there, especially on existing homes. New home sales, however, the supply's been creeping up quite a bit. More people have been building. Today, I wanted to focus not on the supply issue, because I think supply's kept us in a game where we have been able to keep prices moving higher, but talk about affordability, right? You don't need to, if you don't have people listing their homes for sale, that's okay. If the ones that are listed are expensive, can people afford them? And look how low, like the percentage year-over-year percentage point decline, and that's as of 2 months ago, 35% less affordable than it was a year ago. Wow, that's massive. In fact, looking at the top chart here, the affordability, you have to go all the way back to around the financial crisis, the run-up before the financial crisis, to see how affordability has really tanked. So that is not a great sign for the housing market. In fact, I have a quote here, I wanted to pull this up, that mortgage rates, the 30-year mortgage rates as of recently was 5.2%. That is the highest level since 2009. Last year, it hit an all-time low of 2.65%. That means mortgage rates have jumped over 2.16% over 4 months, 2%. As a percentage, that's not quite a double, but that is a huge hit to people that are already on the fence about being able to buy a house. It was expensive before. Oh, and by the way, now you have this mortgage issue. So if it's like in my neighborhood right now, where I live, we've seen a tripling of the supply. I have a very low supply neighborhood, but we've seen a tripling of the supply since the beginning of the year. So my guess is that real estate is going to be a little bit challenged, but I think in some ways that's not great if you own real estate, but that is good because that is also the market doing the Fed's work in helping to pull back some of these inflationary pressures. One of the things that has been coming up as we talked about real estate, I think real estate is it's a very interesting topic Residential and commercial are two different types of real estate. And we use commercial real estate for the appropriate client here in portfolios. We also invest in things like real assets. And we've gotten a lot of questions about this, is like, should we be looking at this as an inflation hedge? And I think maybe that's appropriate to continue looking at. The problem is the prices of these things have gone up. So what I'm showing you here is just like the real return on these, and you can see how property values, it sort of was following the straight line and it just sort of moved to a different direction. That's that red line. Same thing happened with timberland, and then farmland's been consistently moving higher as well. So while these could be good inflation hedges, and once again, we own them in the appropriate portfolios, I think it's not something you rush into because it's a great deal today. A lot of these things are going to move in advance. So I think, getting the reason I like it, real assets, is they can hedge against inflation. What's happened recently is that real assets have appreciated well in advance of inflation. So the question is, as I've mentioned this before, have we pulled returns out of future years into the current year? And that will remain to be seen. One thing that we have been adding to portfolios, we already owned it in one portfolio, alternative income. We started buying it this year in our existing portfolios instead of fixed income, is gold. We haven't owned gold since 2011, I believe, was the last time that we owned it. So, but we think gold is an alternative safe haven. There's a couple of reasons that gold might make sense today. One is because of the fact that with what's going on in Russia and Ukraine, and the ability for the governments to shut Russia out of currency operations, some of these emerging markets that don't necessarily play friendly might be moving to gold instead of the dollar or other types of real assets. It makes the case for crypto in some cases as well. More to be seen on that at a different webinar. But however, gold also performs relatively well when real interest rates, which means the current interest rates, which have moved a lot, but you got to take the current interest rates and then you got to minus the rate of inflation. So when you look at real interest rates below zero, gold has historically appreciated at almost 14% a year. And if we look at where real interest rates are today, lowest they've been all the way back to this chart, 1970. So it does make the case for gold as a potential safe haven. We're not going to be going, gold doesn't pay you anything. You're not owning any equity interest in something. So it's just a store of value, but I think it is a little bit interesting, and that's why we own it across the portfolios. One thing that also is kind of conflicting is the yield curve. Yield curve is the difference between short and longer term rates. When short-term rates move above long-term rates, they call it an inverted yield curve. Historically, inverted yield curves have signaled a recession happening about a year from now. It's been very effective. You see when this thing is spiked above. So what this is a combination of yield curve indicators. It's not just looking at the 2-year to the 10-year or the 3-month. There's a lot of different yield curves. So it depends on what people are trying to say. You can always use your point of view to say the yield curve's either inverted or not, depending upon which level it is. Ned Davis, being as good as they are, they put it all together and come up with a more balanced approach. So when over 55% of the yield curve indicators go inverted, it's been very, very predictable for a recession. And you can see that every time that's happened, this gray area has happened after that. And even including COVID, which came out of the blue. I don't know if the market was smart enough to see the COVID recession, but this did hold true again. So we are not there yet. It is off of zero, so it's moving the wrong direction, and it can move fast, but it is safe for now. And even based on today's and yesterday's move in the bond market, it still looks to remain that case. And then inflation. This is the one that I get a lot of questions about. Yes, inflation is high, right? Yes, 100%. It has gone up a lot. What we look at a lot is what projected inflation is supposed to be, and what we're seeing is the 5-year inflation numbers. What this is all based on market economics, I should say, is that this has been fairly stable for the last couple of months. We've moved up quick, as expected, but we're still maintaining that level. A lot of indicators that I look at without making this whole thing about inflation is we've seen them peak, and we think it could be peaking in the next couple of months. It doesn't mean prices are going to go back down for things, not for everything. But I don't know if anyone's tried to buy a car lately, and you go buy it and it's like X amount of thousands of dollars over sticker price. Market conditions in the financial markets and interest rate moves are going to affect those overvalued autos. high mortgage rates is going to affect housing prices. So there are going to be places where inflation is already being taken care of. The economy is going to take care of itself in a lot of these ways. It's already occurring. And if we look at how long-term inflation, so what this is looking at 10 years minus 5 years. So if the market thought inflation was going to be a huge long-term problem, this would be positive and not negative. With this saying it's going to move up over 5 years and then decline. So both of these figures say, hey, maybe it's peaking. However, we just don't know. The war in Ukraine, it could have a big impact on on supply chains and stuff, as well as food. I'll get to that in a moment. And I think that could have an issue with inflation. So there's just, like I said, conflicting signals across the board on this. And the Fed. So it's pretty amazing, right? Federal Reserve raises rates by 50 basis points. The statements he made seemed to spark the rally yesterday that occurred. Big rally. And then today, as of earlier, we had the worst day of this year. So maybe it's the appropriate day to have a webinar, worst day of the year. So it's all based around the Fed. Right? And I think that is really going to determine the path of things going forward, what the Federal Reserve does. Can the Federal Reserve manage the market expectations here? Typically, markets overshoot, and the way the 10-year Treasury is performing, it looks like it might be overshooting compared to this chart that's on the screen. What is this showing you? This yellow line is showing you, as of yesterday, I don't have today's data, which would include yesterday's rate hike, but as of yesterday, it was saying that 12 months from this 12 months, so assuming the market already predicted where the rates would be in 1 month, which was a 50 basis point hike. So it's saying 12 months from now, it expects the Fed fund rate to be 2.5% higher than where it is today. So call that, 3%. All right? Is that a big deal? Is that out of the realm of where it should be? No, that's getting back to neutral. So getting back to neutral with the Fed at 3% seems reasonable 12 months from now. The question is what's going to happen? I can't answer that right now. You could see how rapidly this thing started moving up, really beginning in January, especially the ascent since March. So that's where we saw a big move higher in terms of inflation, but it is going the right direction. And on top of that, what this is also saying, we can look what the other chart showing is, where do they think rates are going to go after the next 12 months? So 2 years and 3 years out. And it's saying more or less, those are minus numbers, which means they're going to peak and come down. If those numbers were also moving up rapidly, that would be concerning. And that will be concerning if that occurs. That means the Fed is going to engineer a harder landing, which could be recessionary. And they have done that before. And the war in Ukraine is a big unknown. It's terrible on so many different levels, and it's just there's that scariness factor to it, and that's how wars are, unfortunately. Economically speaking, besides the supply chain constraints and some issues there, between Russia and Ukraine, they control a lot. I don't have the energy up here, which is obvious, but they control a lot of what goes into food, right? You see the percentage of what they worldwide trade on terms of wheat, sunflower oil, barley, and things. So barley, beer drinkers, right? Prices are going up. So if that continues to remain a problem, food prices can remain elevated. And for those of you that shop, to go to the grocery store, they're already elevated. So that is a part of the inflation that the Federal Reserve just cannot control this piece of the inflation. It cannot control the oil prices necessarily because of what's going on in Russia. It cannot control these specific food prices, and it cannot control supply chain constraints due to China shutting down for COVID. None of that. That can all push prices up, and the Fed can hike rates all it wants to. So they have a balancing act to do to see what are the things they can control. And once again, I already got to how that would affect housing and shelter, which is the largest part of CPI. So where does that leave us today? That leaves us at a very sort of balancing act on this market weight for equities. We're sitting right in line with our benchmarks, having taken them down earlier this year. We are underweight bonds, and it says overweight cash. What does that mean? Well, we're actually holding a fair amount of money in one-year Treasury bills, up to I think 10% in some of the more average portfolios. So I consider that something close to how cash performs, because it's not down this year like bonds are. So we do have buying power across the accounts to buy either bonds or stocks. We're market rate across the board in terms of our holdings across U.S., large, mid cap, et cetera. I missed the mid cap, but we're market weight there. And international shows both market weight and overweight, because we're overweight currently in the retirement accounts where there's no tax consequences. It says we're underweight duration, which means we're holding shorter term bonds in addition to holding the short-term treasuries. And now we've added a new position called gold, where we're overweight because our benchmark has no gold in it. So, as I mentioned, I want to put this, I stole this quote from someone and I forgot exactly who I stole it for, but we've been using it here because I think it entirely reflects how we feel about things, which is like, this is not the time to be making bold predictions. Well, it might be, and you could be right, but I just think there's too many potential conflicting signals and things that can happen out there. There will be a time when you want to make a bold prediction, and hopefully we get that move right on our side here. Most of the things support a neutral allocation, although I will say that yesterday, unless today ends in somewhere well off those lows, it's not a good sign. So we'll have to just continue to watch that. Fixed income's been hard, but it's going to hit hard. But the key outlook's around inflation. I think ultimately, if we see those inflation expectations come down, if we see the market overshooting on interest rates, we look today, you can almost get, we were checking, you can get up, depending upon where you live and stuff, like we're getting back to a 4% municipal bond return, tax-free. Now that's starting to look attractive, right? So there are going to be opportunities here. And I think that the near term, however, is going to lie with the Federal Reserve and the war, two things which we just cannot predict what they're going to do. So we're going to let the weight of the evidence dictate the next shift in terms of our move. And remember, like taking a step back from this, this is what financial markets do. They go up, they go down. It's a bummer to see the number of the dollars go down in some accounts. I mean, we operate in percentages here, but people operate in dollars, and I get it. So it's a bummer for me too. We look at assets under management in a $1 billion and a half dollar firm, and you can't say $1.5 billion anymore. So it does affect us. So we obviously want to manage things the most appropriate way, but we understand that it's very, very hard to time the market with large amounts of capital. So I think it's easier, however, to try to determine when a bottom has been put in, and that's where the real money can be made, and that's where we'll be looking to add aggressively. So with that, we'll take people through our compliance. So with that, if there's no other questions, we always appreciate your trust and confidence, and if you need anything, let us know. We're here for you. Have a great rest of the day.